All right, guys. I figured I would come on a little bit early here, so caught some caught some stuff on Palantir here. It seems like it's just a love or hate type of stock. So I kind of just want to get on here and do a quick review on Palantir. I have it on a watch list, and I think it's a sticky company. I think there's a lot of opportunity for Palantir, and so basically, I just kind of want to refresh and go over some numbers. So as people start piling in here, guys, if you could just smash the thumbs up and or give me a thumbs up to let me know you can hear me, and we'll get the show on the road. Glad we could have you, Lawrence. So yeah, first and foremost, guys, I'm very unemotional when it comes to investing. I'm not interested in stories. I look at the fundamentals and I figure out what my risk versus reward is, and then I go from there. So for me, I really don't love the story on Palantir. That's not why I invest in it. What I do see with Palantir is a pretty interesting opportunity with when you review the fundamentals of the company, there's a lot of things you have to like with the company. Now, with that being said, there is a lot of risk with Palantir here, guys. Okay. One of the downfalls is going to be stock-based compensation. So what I've got up here, guys, is I have ladies and gentlemen, because I'm sure there's females in here. So what I have up here is their quarterly report. And so I kind of just want to shoot it straight forward with you guys, go over the pros and cons of the company, and then we can go from there. So, first and foremost, guys, 3 years ended in March. Okay, they did 341 million to 446 million. 31%, roughly 31% gain, okay, year over year for the quarter. What do I like about this is the fact that they gained 105 million, but cost of revenue only went up about 20 million. Those are numbers I can get behind, okay? Gross profits still remaining strong for the company, all right? You're talking about over 75% gross profits. Other things that I like is the business model is sticky. And when we go through the quarterly report, one of the bonuses that we have to pull out from this is the fact that they're growing their contracts in the private sector. Let me just make sure I got this because I know I scrolled through it really quick here. So give me 1 second. Private sector growth was impressive when we look at it. So they're not just relying on government contracts anymore. They're growing outside of government contracts. So I like that as well. Accounts receivable grew by 65 million. So assets are growing. That's the right side of the balance sheet. That's what we want to see. So everything so far that I've seen with Palantir, I really like. Now, the downside is the stock-based compensation is absolutely out of control. And also, that is something that is diluting shareholders. But what we're going to do is we're going to run a kind of discounted cash flow analysis and an EBITDA analysis to see roughly what we think we should be paying for the stock. So, those are things that we're going to do because I do have Palantir on my watch list. I have a small position when it broke down to $7. And I think there's an opportunity that the stock's going to get cheaper in this market. So these are things that, I'm personally excited about because I think you're going to be able to get the stock cheaper. And, if you believe in the company long term, then it's a great time to acquire it. Now, I wasn't one of these people that was buying the stock at $25 and $30. If you guys have been following my channel, I stated that when people were buying it at $25 and $30, I thought at most it was a $15 stock. Okay, I thought it had to come down 40, 50%. Now, after the last few quarters, stock-based compensation margins shrank a little bit. You have to keep ahead of that. You have to look at the quarterly reports and make sure the fundamentals are lining up with what you're trying to accomplish as an investor, right? Total stock-based compensation has come down from an expense standpoint. Good to see. Problem is the price has come down too. Okay. Net loss came down. Good to see. So they're heading in the right direction. We're going to go over the broader things on Palantir as well. So guys, this is what I'm excited about, okay? Commercial sector, guys, went from 132 million to 204 million year over year. That's a heck of a growth. Like you're not going to find these type of growth numbers in a lot of different stocks, okay? Government grew pretty strong as well, almost 20%. Actually, I think if we scroll down lower, they'll break down the percentages here. Most of their money coming through Most of their money still coming through United States, but they're growing. They're still growing United Kingdom and rest of the world. Roughly another 15-20% growth rate there. Only about a 10%, 15% growth rate in United Kingdom. So not a huge growth there. But private contracts are growing. They're not just relying on government money, which I like to see, because if the government stops spending, you want to make sure that this company can still get through hard times and that they're more sustainable outside of the government, right? So look at the gross profits. Now, gross profits came down from 83% down to 81%. Okay. When we pull up competition for gross profits in the sector competition gross profits are 50%. Okay. Which means, and this is not even accurate because Palantir is closer to 80%, which means that they're absolutely dominating the sector median here, guys. Okay. They're dominating the sector median for gross profits. Another thing I like to see. EBIT margins, obviously, they're not profitable quite yet. Although if you back out stock-based compensation, there's an argument to be made there. So EBIT margins are obviously negative, but I do think that there's projected to be profitable here in the near future. So definitely some risk with that as well. So we have to be realistic with our expectations. We have to weigh the pros and the cons. So we got some comments in here. So Jeremy, excited to see about Palantir long term. I believe it will be a winner. Also excited to see. Okay, cool. Yeah, I think Palantir is going to be fine. I think that we have to look at possibly stock-based compensation slowing down here. But when I look at when we run the numbers and we do the discounted cash flow here, I think you guys are going to get a realistic. I'm not a pumper here. I don't pump stocks and I don't just crap on stuff. I have to see stuff that I actually like. So for me, guys, I shoot it straight. And unfortunately, people either like you to pump a stock or crap on a stock. And it's just not what I do. I kind of just try to see it for what it is. So commercial grew 54%. Okay. Total revenue grew 31% and government grew 16%. So good to see the commercial growth at 54%. Now, here's what gets me excited about the business. And you're not going to see this a lot with other companies, guys. When you're looking at cost of revenue here, okay, I want you to pay attention to this because you don't see this normally with other companies. I don't know which one's going to be easier for you guys to see here. Okay. Both are pretty, I don't know how to make this any bigger for you guys, but all right. So I'm just going to rip off what the revenue was. So in 2018, the revenue was 595 million. In 2021, 1.5 billion. Okay. So 300%, roughly 300% or 3x revenue growth, right? What is exciting about this is cost of revenue, guys. Cost of revenue is flattening out. So when their cost of revenue is flattening out, but yet their top line still growing 30 and 40%, that is future margins there, guys. Those are future margins you have to absolutely consider. So when I see that, I don't normally see that with a lot of other companies. So while there's a lot of risk here, you can start seeing the opportunity. And I don't know if you guys can see this, but so in 2020, they did call it 1.1 billion in revenue. Okay. Operating cost was 352 million. In 2021, they did 1.5 billion in revenue and operating costs came down. Okay. So that's what you have to be excited about. Now, what I'm noticing is operating costs are kind of spiking up here for the trailing 12 month, as I'm sure there's reasons why, but it's a little bit of a spike up from what I remember cost of revenue. So cost of revenue is jumping for the trailing 12 month, just to give you guys a heads up. But still, it's not getting out of control. It's still maintaining fairly flat as revenue is, as top line is growing. Cost of revenue is actually maintaining flat and could possibly come down in the near future. So you don't normally see this kind of growth with operating cost and cost of revenue coming down, right? One knock on the company, guys, is going to be stock-based compensation. So what I have in front of you right now is a discounted cash flow on the company here. So we're just going to run through the numbers really quick. All right. So everything that I've read and everything we can look up here basically is looking like forecasts for the company. We have prices as low as $6 and as high as almost $16.80, about $17. Okay. And I've seen as high as 20 on some estimates. Now, the revenue is projected to do about a little over 2 billion this year, which would be 31% growth, 2.6 in 2023, 28. So as we can see here, we're looking at top line revenue growth from analyst expectation to maintain above 25%. Okay. Now, I'm not going to be that aggressive in my analysis, all right, because we're in a contraction period and I could see people possibly making some cuts here, and I want to make sure that I'm not being over aggressive with my analysis on this. So what I'm going to do is I'm going to use 24% revenue growth for the next 3 years. Okay, I'm going to use 19% revenue growth for year 1 through, actually we'll use 16% revenue growth for year 3 through 6, and then I'm going to use high single digit revenue growth for 6 through 10, which is about 8%. Okay. So now I'm being very cautious with my revenue growth. Here is the problem, guys. Stock-based compensation ruins the price of the company. Okay. So let me just, I don't know if you guys can see this. I don't think it makes that big of a difference, but we'll go like this. So all right. So stock-based compensation is ruining really ruining the true effects of being a shareholder of the company. Okay. So the question becomes twofold here, guys. The question is twofold for, let me go over here. The question is twofold for the company. First question is this. Okay. What do you think their revenue growth is going to be? Okay. That's an honest question you have to ask yourself. Now, I can bump it up here a little bit, or I can, you can always finagle the numbers in your favor. So it's always good to kind of go in with realistic expectations. Now I'm going to take a look at what Yahoo has. And if Yahoo is outrageous and 40%, maybe I'll bump up these estimates a little bit. So first thing is revenue growth. Okay. Second thing is, what are their EBITDA margins going to truly be long-term? Now, I think they're going to be in the high 20s to low 30s. So I think over the next 1 to 3 years, average EBITDA margin is going to be right around 15%. I can actually bump up 3 to 6, probably closer to 25% margin growth. Okay. And then 6 through 10, I could see it being closer to 30%. So this is me being honest with the company and what I can see coming out of the company by looking at the numbers and going over long-term here. Now, they've had an average of revenue growth of high 40%. So for me to put 24% in there, guys, I'm pricing in recession doing that. Okay. I want you to understand that. Now I can come up here. If we don't go into a recession and they maintain strong revenue growth, I think over the next 3 years, they can do closer to 30% revenue growth. Okay. Which would also put 3 to 6 years out, probably a little bit higher as well, 19%. So you can always work the numbers in your favor, okay? But you have to do what you think is appropriate. What kills the stock, guys? What kills the stock from a fundamental standpoint is I have to compensate, or I have to put forward what I think their stock-based compensation is going to be in dilution, okay? Currently, I have a 6% year-over-year compounding growth rate on diluting, all right? Now, personally, this company reminds me a lot of like an AMD. Okay, AMD was kind of left for dead. Had Apple was their biggest customer and had some debt, issued a lot of shares, and look at what AMD has kind of turned out to be. So, with every risk, there is that reward that can come along the way. So I'm going to lower the shares because I'm going to take into consideration what what management has said about stock-based compensation coming down. I'm going to limit it from 6% down to 2%. Okay. So if you think that they can maintain a strong growth rate of 30% over the next 3 years, 19% over the next 3 to 6 years, and then 8% from 6 to 10 years, and they don't dilute, guys, that's the key. And they don't dilute. You're looking at a fair value in 2030 of about $16 to $17. Okay. So I would say that this seems appropriate if they don't dilute. Now, if they do keep diluting and stock-based compensation is going up, and that's what they're doing, you're looking at $11 to $12 stock. This is why it is so important to build safety within your analysis. Okay, this is a lot of times people get so excited about the story that they're not building the safety for them as an investor. Do not fall in love with the story, guys. They want you to fall in love with the story because they want you to buy and hold long term and bring value into their stock. Okay. But you, as an investor, have to think outside of that realm and say, if I were to invest in this, taking the story out, taking my emotions out, what is fair value for this company, right? For me, guys, this is why I said I would buy it below $7. Fair market value with these numbers is $6.72. Okay. That is why I think personally, to me, guys, I look at Palantir as mainly anything in that $7 below. Maybe even if you want to get a little aggressive with the growth rates, I can understand going 8 or below. But for $7 to $8, guys, below is where I would be looking to add. Okay, that is just me personally, and doing this and not falling in love with the story this is my calculations, guys. You can make your own calculations, right? So we're using a 6% increase year over year of share dilution. Okay, whether that's through stock-based compensation, that's however, it's proven that that's what they've done. Okay, so I really wouldn't change that. You might want to use 3 or 4%. Maybe I'm being a little too aggressive here, but if you use a 4% increased shares versus 6, okay, it brings up the stock closer to $14. If you want to get aggressive with the growth rate and say that in year 1 through 3, I can see them doing 30%. In year 3 through 6, I can see them doing about 22%. And then in year 6 through 10, they do 9%. Okay. You're looking at a $15 stock. Okay. So it really depends on how you're painting this picture for your investment. For me, guys, I think anything $7 and below makes a lot of sense. Okay. And how I would buy this is I would actually use I used cash secured puts when I bought some of Palantir already. So basically I put $1,800 aside, cash secured, or it was a little over $1,800, cash, a few hundred shares of cash secured puts, got the fill on it, collected a premium, and I'll probably add a bunch more going into July 15th, 16th, 17th, as I do think this is going to be a frothy few weeks. I think next week, the short week, is probably going to be some optimism. We're going to probably trade flat to up. I think the week after following, going into the Fed's meeting and going into earnings, I think there's going to be a lot of fear within the market, and I think we're going to see some crazy selling going on. It's just me personally. When I pull up the technicals on the market here, guys. So when we pull up kind of the charts on the market here, hold on one second. Let me minimize this. And if anybody has any questions about Palantir, if they want me to run numbers a little differently, put them in the comments. Okay, I will run the numbers, but make sure you're using revenue growth, shared dilution, and EBITDA. Okay, margins on EBITDA. Okay, earnings before interest, taxes, depreciation, amortization. So if you are in the chat and you want me to mess around with the numbers on Palantir, okay, put them in the comments, and I will mess around with the numbers and give you what I think the 2030 stock value is and where you should be entering to get a double-digit rate of return. Okay, so and I have that rate of return set around 12%. So anything below $7, I think you can expect to get between a 10 to 15% rate of return, as long as they don't do anything stupid. Now there's a lot of risk involved with that. Okay, so I want you to understand that. But I want to go over kind of just a quick technical. So if anybody has anything they want to say in the chat as far as they want me to rerun the numbers for Palantir, go ahead and put them in there. Yeah, I think 6% is a safe bet. I honestly think that you probably want to use a lower rate of return, a lower one of return, because what happens is as the compounding dilution takes place, they're going to need less and less percentages of the actual shares. So it probably makes sense to use 3%. So I might cut that in half. Okay. So I actually might use 3%, because when you're talking about they have 2 billion shares outstanding, 3% compounding year over year over year for the next 10 years is a lot of shares. I don't necessarily think they need to dilute that much, but I don't know. Really just depends. That's the that's kind of the caveat with this. So I'll run your numbers here in a quick second. 30% revenue growth in the first 4 years and 15% the rest of the years. Okay, I can run that in a second here. But what I want to talk about really quick is just kind of the state of the market. It's been very predictable. 4.5 stock-based compensation. Yeah, I can run that really quick. So guys, what we have going on here is we have a battle between bulls and bears for the market. Absolutely. The way we can see this is just kind of how we've been trading, and the dojis here are just very, very, just not a lot of action. There's just a very tug of war here. Interesting enough, we've been trading in a pretty clear channel, guys, on the 180-day chart here. It's a pretty clear channel down. We're putting in lower highs and lower lows, lining up pretty well with the Fed's meeting. Okay, so when the Feds go to meet, that during that week, we've been noticing that's when the sell-offs actually take place. Then you get the relief rally after the meeting. So it's been very strange here. But what I think we're going to have is I think we're going to have a little bit of relief rally going into this week. Looks like the technicals want to turn over on the shorter term charts. Okay, so I think we'll get a little bit of a relief rally, maybe trade fairly flat. Could head up to about 390, so about 2 to 3% move to the upside, I would say next week would not surprise me. The week after, guys, I think we're going to see some volatility as we line this up with the VIX. When we line this up with the VIX is forming a wedge here. So I do think the VIX will kind of trade sideways to down here. And I think where the VIX is eventually going to explode to new highs, that's going to be our next leg down, in my opinion. Okay. This is not financial advice, guys. This is just my opinion from what I'm seeing here. But I can see the VIX has got a 4 count to the downside. So I can see the VIX cooling off here, hitting this line of support. This trending line up of support here and heading up into this ascending wedge and eventually breaking out of this wedge for the Fed's meeting. Looks like it lines up pretty darn well with that, guys. Not trying to scare anybody, but that's the movement I'm kind of seeing with the VIX on the shorter term chart and the S&P 500 on the shorter term chart, lining them up together. That's the action that I think we're going to see going into the next few weeks. Okay. Let's go back to really quick. We'll go back to, we'll rerun the numbers here so we want 30% growth for the first 4 years. Okay, so then I got to average out 15 a year of 30. So that would be closer to 18. 18. And share increase of 4.5%. So you're looking at a good entry point. You would be looking at around $8, below $8 a share. And you're looking at between $15 to $18 would be about a price target I would be looking at if you're running those numbers. Okay. So, yeah, that's what I would guess for that. Now, of course, this is all biased and this is all depending on, what expectation is for the company, but, good jumping off point here could make a lot of sense. It still kind of lines up with my watch list here of basically, I think anything below 7 makes a lot of sense. So here's the thing, when you look at this company, and I know people, I think we could see it get super cheap. I'm not going to say that. I would not be surprised if we see a $5 stock because we get a massive sell-off. What you have to understand, guys, is when the markets sell off, usually 66% of the stocks participate with an overall market sell-off. So if the market has a massive dip, 66 to 70% of the stocks are going to dip with the market, guys. That's just the way it goes. So even though fundamentals are fairly strong within the company, it could absolutely dip with the market and we could see ridiculous prices once again. But in my opinion, I think you have to start looking at this company below $7 for a few reasons, guys. Obviously we can see here top line revenue growth. It's only a matter of time before this company is cash flowing pretty strong here. So, when is that? It could be 2024, 2025 could really start paying off as far as you accumulating shares below that $7 mark could make a lot of sense. Okay. When we run it from a DCF model, obviously there's not a lot of cash flow there. So it's really tough to kind of trade it off of. I'm also using, just to give you guys a heads up, I'm also using a 15 multiplier here. Now, I think that's a fair multiplier as the company matures. I think a 15 multiplier makes a lot of sense. But if the company's still growing double digit, guys, I could justify a close to 17 or 18 multiplier here, which once again would bump up the stock pretty significantly. So the question becomes, Zhang, if they can maintain double digit growth from 6+ years on, you're probably dealing with a higher multiplier for EV to EBITDA, and you're going to probably, I could understand justifying buying it, in the $8 or $9 range possibly. So if you're that convicted on the company, could make a lot of sense. For me, I think anything below 7 kind of makes sense for me personally. I hear people talking about it going to these zero and going bankrupt. I don't necessarily see that. Could they dilute the crap out of us and force the price down to $4 or $5? I could see that being a likelihood. I don't see the company going anywhere just because they have government contracts. It's a needed business. They have plenty of cash on their balance sheet. They have hardly any debt. So they have $2 billion in cash and $260 million in debt. I mean, they could stroke a check for their debt. They don't have to necessarily do stock-based compensation. There's a lot of things that this company can do. They could even buy back some shares here, and that would cause some optimism in the price as well. So yeah, so I mean, that's where I think I think buying it below those price could make a lot of sense. So wanted to come on here, kind of give you guys my 2 cents on that. Does anybody else have any questions on any other companies that maybe you want me to look at, or maybe do a video on? I'm not saying we could do it tonight because I'm probably going to sign off here in a minute, but does anybody have any other companies that, yeah, I mean, that's about where I would put it. That's why I think buying it below 7 makes a lot of sense. I think you still have a good amount of upside with the company, and, overall, I think personally, that's just where kind of my numbers equate to, is around that $7 mark. So is anybody on here want me to review anything else or take a look at anything? Just give me a shout out. Let me know. But that was kind of our quick dive into Palantir. Reason why I wanted to dive into Palantir is just hear a lot of talk on the company, and I hear two sides. Okay. I hear the very bullish case that is a little too bullish in my opinion. And then I hear the bearish case where they're going under, and I tend to be fairly neutral about any investment, guys. I tend to be very neutral about any investment. I try to go into it, no emotion, don't fall in love with the story. Let's look at the fundamentals and try to figure out where's a good risk versus reward. Now, a company that's growing revenue, consistently at 40% year over year, and putting a 30%, to 20% revenue growth and getting it at a certain price point, to me makes a lot of sense, especially when we talk about the margins that this company could have here. So technicals for HIMS. I got a dedicated video coming for HIMS. I'm going to do a dedicated video for HIMS, but I'll take a quick look at the technicals. So we're going to go to a 1-year chart on HIMS. Obviously, guys, we see this massive sell-off here. Interesting enough, breaking a trend here, breaking out of a wedge. A 1 count to the upside here. This looks pretty bullish, guys. Got a couple good things rolling with HIMS here. First off, got the MACD rolling on the right side of things, and buy signal. You've already had a nice move up with a 1 count, completed a 9 count, pulled back a little bit, hit this line of support. I haven't looked at this in a while, but look at how it hit this line of support. Oh, you guys can't even see because I don't have the video up. Look at this line of support it hit right here, guys. This was drawn months ago. It's got above the 10-day moving average. Very bullish signals here for HIMS, guys. Has a nice uptrend forming here. Very nice bullish trends here in HIMS. I wish I would have caught this one. So if I were, if I were trading this, I actually like HIMS long term, so I wouldn't even necessarily say trade it. But if I were to enter a position in it, I would have entered right on the break of here, right on the break of this wedge here. So you had a nice bounce off of this technical move. You broke out of a wedge with a 1 and a 2 count to the upside. That would have been a great time to buy. And that move would have been, you broke above the 10-day moving average as well. So that's a 22% move in like a week. So nice bullish move. Yeah, nice bullish move on the company. Looks like it's definitely in bullish territory here. It'd be interesting to see how good how it recovers here. It's very bullish move actually, from $2 all the way up. Yeah, I wish I would have bought $2 looking back at it now, man, got completely oversold at that point. Man, yeah, what a return you would have had if you would have bought it at that dip right there. And I'm going to be running a full video on HIMS here in the near future. Thanks to Venue, who I do a lot of phone calls with. Venue, he's been a huge help to the channel, and he's been helping out with kind of putting together material to kind of create around. So really like the setup on HIMS. I would be put a tight stop loss on it if it broke below this moving average. But if you're holding it for the long term, obviously don't worry about it. But if you're trading it from a technical standpoint, if it breaks below the 10-day moving average and then breaks below this line of support, I would probably be out. Yeah. That was a good little purchase for you there. Nice run up on that one. So good on that. Another one I want to talk about, guys, is I want to talk about kind of Micron here. That's one that I actually like long term. I think there's a huge demand for chips, and I think chips are, unfortunately, the chip makers are going to lead us down in the next leg. Okay, so I think the chip makers are going to lead us down in the next leg. They're obviously signaling, a massive slowdown in the economy. They've been pulled forward, a lot of inventory in the chip makers, and now demand is slowing. So it's not looking good for a lot of the chip makers, but I personally think that this could be a great buying opportunity at the right price. So I have a mark at 41.78 on Micron. If it gets below 40, if it gets that $40 mark, I'm very interested in Micron long term. Intel, to me, guys, just really quick, Intel to me is a little bit of a value trap, and I've talked about this numerous times. Now, Intel, when people were thinking it was a great buy around that $41 mark, I had a watch list of breaking 30. So I think there's an opportunity that we could see Intel touch $30 a share, guys. Reason being is, their CapEx is exploding. Okay, so their CapEx is exploding. Demand is slowing. Let's pull up the fundamentals on it really quick. I just want to walk you through this, guys, really quick before I let you go on the chip makers. I think it could be a great buying opportunity when we think about where we are in the economic cycle. So right now, how we're going to know we hit a bottom in this market, guys. And everybody's like, oh, you can't tell if you hit a bottom. Here's how I think we're going to know when we hit a bottom is when the banks are bullish and the market is selling off. If the banks become bullish, okay, if the banks reverse, I'm talking about your JP Morgans, your Wells Fargos, when those reverse and the overall S&P 500 is flat to down, that is when I think we've hit the bottom. Okay, so I think the banks are going to lead us out of this downtrend. So what company was I looking at? Oh, Intel, guys. I want to go over why I think Intel is a little bit of a value trap. Okay. That's not Intel, but that would be nice if it was. Okay. First off, guys, revenue, obviously, we know a lot of their revenue got pulled forward. I think I want to use the trailing 12 month. So Yahoo has the trailing 12 month. So we obviously know revenue got pulled forward, especially when we think about COVID, right? So 77 million to 79 million. What's happening right now is they're losing market share. Okay, they're losing market share to other chip makers, and they're spending capex. Okay, couple things I notice about Intel here, guys. They've normally bought their shares. Okay, they've normally been what you consider a valued stock. Okay, they buy their shares, they pay a dividend, they don't grow their revenue much. Okay, that's kind of been Intel, but they're a cash flowing machine. At least they've been a cash flowing machine for many years. Okay, we're starting to notice a tick up in shares on, it's only 8 million. But when we look at what they've done, they went from 4.5 billion shares to 4.2 to 4. And now they're starting to put shares on the market. Okay. On top of that, guys, debt is growing. Okay. On Intel, debt has went from 23 billion to 33 billion. 26 billion to 38 billion. Okay. That's a lot of growth in debt. Okay. So a little bit of share dilution coming, nothing major, but something to keep an eye on. A little bit of share dilution coming. They're losing market share. They're spending capex, and debt is growing. Okay. Some concerns here, guys. Nothing to freak out about here. Now, if you're a long-term investor in Intel, I'm not saying you need to sell it. I'm just saying you need to pay attention to what's going on here, as they're losing market share. They're spending. Cash flow is going to get disrupted. Okay. Absolutely going to get disrupted. When we look at cash flow going from 14 to 16 to 20 down to 9, okay, something to think about. So Celsius energy drink. Okay, I can take a quick look at Celsius here. We'll do, yeah, okay, it was at CELH. Yeah, let me break down Celsius really quick. So PE ratio of 507 seems a little high. Okay. Revenue growth has been strong. So we got 52 million to 75 million to 131. Does it have free cash flow? Free cash flow is negative. All right, I'm going to run, guys. I'll run a quick analysis on Celsius here really, really quick. Okay. Let me think. We'll run a quick analysis on Celsius here. All right. So 5-year expected growth on Yahoo is 59%. So they're expected to grow 59% over the next 5 years. Forecasts. Let's take a look at forecasts on Celsius really quick. So guys, this is going to be at a little bit of an extensive dive in here. Give me a few minutes. So we got a wide range here between $55 to $126. Looks like average growth this year, they're projected to do 90% and then 44, 36, 37. So pretty strong revenue growth across the board. I'm guessing, that's pretty consistent revenue growth. So we're going to use 50%. It seems like 50% is definitely in line for a 1 to 3 year mark, down to 35%, and then down to 15%. Okay. EBITDA margins on the company. Let's see. So EBITDA margins are probably going to grow because they have gross margins. So we'll put the EBITDA margins at 8% for the first 3 years, 10%, and then 13%. So we'll go EBITDA at 8%, 10%, and 13%. I don't know much about the company. Put in the comments if you understand where margins are supposed to be in this company. Put in the comments where you think margins are supposed to be, and we can go from there. Um, Cash flow from operations. So we'll go keep that there. Cash growth. Take a quick look. So right now I'm just kind of ripping through just basic stuff here. Now, if I were to dig a little bit deeper here, I would be going through the quarterly reports, but I just want to get an idea kind of where this company is. So I want to point out one thing right off the bat I can see here. Is the fact that the company's cash and cash equivalents has come down drastically. Okay. So it went from 23 million to 43 million down to 16. Okay. And I'm pretty sure if I were to look that they're diluting. So they're obviously spending to keep up with growth, which is fine as long as the growth rate is not, as long as their diluting is not outpacing the growth rate. Okay. So that's something you want to keep an eye on. So cash and cash equivalents is sitting at 16 million. Okay. They were at 42 prior to that. Cash is coming down, something to keep an eye on. We got revenue, top line revenue has went from 34, 90, 131, and 314. So we got 90, 131, 314. So 90, 131. And 313. No, that's at, yeah, 313. So, oh man, Joe, appreciate it, brother, man. Thank you so much. Appreciate that, Joe. Trailing 12 month on there. So we don't have a trailing 12 month. So I would have to pull up the quarterly reports for the trailing 12 month on that one, but we'll look at that after. Can't thank you enough, man. Really, really appreciate it. It gets hard when I'm going to talk a little bit here. Hopefully you guys enjoy while I'm talking, but it gets hard to see YouTubers with multiple 100,000 subscribers not able to do basic investment advice, and they're just absolutely killing it. And it's hard, but like this kind of stuff gets me excited, helping you guys out, giving good sound advice to the best of my ability. I'm not perfect, but I try to help out as when I can. So just to give you guys an idea, there is share dilution going on. So it went from, I don't know if this was a SPAC or not, so we're not going to get into that tonight, but basically went from 57 million shares to 74. Nothing too crazy, but definitely something you want to make sure you keep an eye on with shares, guys. Is it's just a way to lose value there. Unfortunately, with a lot of these growth companies, you're going to deal with that. But the one way you outweigh that is making sure that the growth is way stronger than the actual diluting taking place. So, same kind of stuff you deal with on the basis with like a company like Palantir, right? So 60, we'll call it 69, 72, 74. So it's not too bad, actually. It's really not too bad when I look at it. It's really not bad at all, actually. 69, 74. 74 million shares outstanding. So not bad for the dilution here. So we're going to go cash growth. We're going to just give it, I don't know if you guys can hear that, but we have fireworks getting shot off over here. Wow. So this is looking like a pretty strong buy here. Let me give you a quick rundown. Hold on one second. Let's go over debt really quick. Make sure they don't have any ridiculous debt outstanding. Total debt is only at 1.3 million. So they hardly have any debt, guys. This is looking pretty interesting here. Now, I want you to understand something. Just because I'm running these numbers, guys, does not make it a buy, okay? These growth rates are pretty ridiculous. So if you think that they can do this, then it's, you want to get in. You had mentioned earlier that your buy was at 8. Has that changed? It was actually a little bit below 8, Joe. It was a little bit below 8 on that one. If you're talking about Palantir, it was below 8 because I bought I had cash secured puts, Joe. So what I did was it like I think it was $8 cash secured puts. So I collected a premium and got the fill, which I forgot what the total amount was, but it wasn't it was a little bit below 8. So yeah, that's what I did on that one. And I'm looking, Joe, I personally think it can go a little bit cheaper. So that's just my opinion. I just think we're going to see another leg down. You're going to have an opportunity to possibly buy it between $5 to $6. I think we might see it reapproach those lows again. Very, very interested to load up at that point in time. Kind of got lucky with the cash secured put fill. So just to give you a recap. Okay, so what I would do on this one is let me just check the multiplier really quick here on Celsius. So guys, Celsius is looking pretty darn interesting here. Starting to get a little expensive, but let me see. EV to EBITDA is at 917, which is ridiculous. We have to figure out what would be a decent EV to EBITDA on that one. Where is it? I don't know if I'm going to be able to get that. In the comments, what's up, Tony? In the comments, can you put down what you guys think Celsius' biggest competitors are? Actually, I can do it here. Sorry. But so it's Coke, Fizz, Primo Water. So we'll go with Fizz. We'll go with Fizz really quick. I need to get an idea of what I should be looking for EV to EBITDA on the company really quick. Hold on one second. So Fizz is EV to EBITDA of 19. Let's see what Coke is. EV to EBITDA of 21. So I'm going to be cautious here, guys. I'm going to use an EV to EBITDA of 20. Okay. Actually, we'll use 19. All right. So, guys, fair market value, in my opinion, for Celsius is going to be right around $89 to $90. Okay. I don't know why fair price is coming up that high. What entry point would I be looking to buy? If you get a chance to get it in the 40s, I think it's a good buy here, guys. So let me pull up the chart on it really quick. So to me, guys, between $53 to $40 in Celsius could absolutely be interesting if they can keep up with the growth rate. Okay, these growth rates are pretty ridiculous. I'm not going to lie. Growth rates are pretty ridiculous on this company. So I want you to be cautious of that. So what I want to do is I'm just going to lower the growth rates just a little bit. Okay, just to kind of make sure we build some safety in there. But oh, Anthony, I'm in Tampa, brother. We'll have to get together sometime. So this stock hit a high of 110 and has a nice ascending wedge forming here. You're probably going to get a little bit of a pullback. Might get an opportunity to buy this in the 50s, guys. If we get a market crash, you might retest the lows, probably get to the 40s. So from a technical standpoint, guys, I would say that you're probably going to hold 55 unless if something crazy happens. If something crazy happens, you have an opportunity to possibly catch it in the 44 range, 43, 44 range. I'm actually going to put an alert on it if it breaks below 54. I think this is an interesting company. I have to do a little bit more digging on this one, guys. Okay. I'm not saying it's a buy at these levels, but just kind of running the numbers here. Pretty impressive stuff, guys, for Celsius. So let me just pull up the calculator one more time. So we got Celsius. Yeah, I mean, we got a fair market value in 2030 of between $89 and $90. I mean, you know, if it trades for an EV to EBITDA of closer to 2021, you're looking at 93. Yeah, this is an interesting stock, guys. I think a price target of 53. I think that makes a lot of sense. That lines up exactly, guys. That lines up exactly with the chart that I just pulled up here of the technicals. So I literally just put an alert at 54.50, and I got an intrinsic value on the company around $53. Everything's lining up for this one, guys. I would be very interested in this stock below $50. Very interested below $50. I don't know what your cost basis is on it, but that's a pretty those are some pretty interesting growth rates for the company. And I even protected it by throwing a little bit of share dilution in there. So let me just double check and make sure I did that, but I'm pretty sure I did. Share dilution of 4.5% year over year makes a lot of sense. We'll even bump this down to 40% just to see what happens. Still at $76. Very interesting. Yeah, I think this is a good one. So yeah, this is an interesting one, guys. Really like this one a lot. So that was Celsius. Very, very good one. That was a good call out. Who called that one out? We'll do a quick chart analysis on Google. That was a good call out. Sniff and Poots. Good call out on that one. Yeah, I would be patient on this one. Like I said before, you know, we just did the analysis on it. Very strong. And I think it's a pretty good buy in that $40 range. So something to keep an eye on. Put an alert on it. Maybe I just put an alert below 54. So if it breaks below 54, I'm going to rip into the quarterly report and really dig into it. But just from a basic intrinsic value, kind of looking at a multiplier of between 18 to 20 EV to EBITDA. If it's growing where they're saying it's going to grow, very interesting stock, guys, long term. We'll take a quick look into Google's technicals here. So, Tony, I'm going to give you a quick rundown of what I think about Google, Apple, and with earnings coming around the corner here, and then I'm going to call it a night, guys. So, Tony, to me, Google is going to lead us in the next leg down here, okay, if it doesn't hold this level. I think Google overall has been holding very, very strong as of recently. Looks like it's hitting basically it's stuck in this channel here between basically 2130 and 2350, call it. So it's been trading in this channel, and unfortunately, we have a downtrend forming to the downside here, a 1, 2, 3 count to the downside. And if we break below here, I think what you're going to possibly see, we got a couple negative things here, Tony. First off, and I'm not trying to say sell or buy, or if you're holding the stock long term, guys, don't worry about this day-to-day stuff. But if you're looking to enter a position or add to the position, okay, this is where the technicals come in. So to me, Tony, it is holding on to dear life. I think it's going to retest 2050. I don't know if it's going to retest it this week. I think once again, everything's lining up pretty good with the week after. So we got a short week coming up. I think it'll trade sideways, possibly test 2150, bounce off of there. But I think eventually with the Fed's meeting, it's going to break down. And it looks like it's lining up also with the stock split. So interesting stuff here, Tony, is we have the Fed's meeting that week. We have earnings coming up during those weeks, and we have a stock split coming. You have a very bearish formulation on the chart here. What you have going on is you see that MACD. I don't know if you can see my pen, Tony. The MACD is curling over. It looks like it's going to head down, okay? Along with that, you have a breath starting to the downside. Along with that, you have a 1, 2, 3 count to the downside. Everything to me is pointing that Google's probably going to head lower within the next week or two. Okay. How low does it go? It could hold 2140, but I think we're going to possibly see it retest those lows. That would be an interesting opportunity to possibly build a position into Google if you've been waiting long term for the company. So, not trying to scare you. I'm not sure if you're looking to add or what, but I think I would wait on Google here. It is holding on to this line of support right here, and to me, all indicators look like it wants to roll over to the downside. So, guys, that's Google. Just a quick dive into Google. I'll layer Google actually with Apple really quick. Haven't looked at Apple's chart in a little bit of time, so let's take a quick look to Apple. Um, yeah, no problem, Tony. Look at this though. Once again, Apple's similar setup to Google, not as bearish as Google, guys. So Apple looks like it's going to reverse here. It's got some bullish divergence going on here. So what's happening in Apple is you're actually getting an uptrend formulating here after it hit a new low. You have the MACD kind of trying to head to the right upside here. Looks like the breaths are turning over. To me, it looks like Google is going to be more bearish than Apple in the near future. Now, over the next week or two, that could absolutely change as things formulate day to day. So that's why the technicals, every day it changes, right? This is a 1 day, 1 year, 1 day chart. So every single day, depending on what news comes, how the buy and sells come out, how the chart formulates, it's going to change the direction and the momentum and the overall thesis of the movement of the stock, right? So right now, Apple hit a recent low of 129, bounced pretty hard off of that. Looks like it's trying to recover from the recent lows. Has some bullish divergence going on here. So I think Apple is a little safer in the short term. To me, Google looks pretty scary, guys. I think Google might retest lows. I think Google might retest lows. And the retesting of lows looks like it lines up pretty darn well with the stock split. So I'm wondering if people are going to sell off when they get additional shares of Google. Obviously that's me thinking a little bit deeper there, but just something to keep in mind. So, guys, I'm going to sign off. If you have anything dire right now that you really, really want me to look at before I sign off, I'm more than happy to take a quick look, and I'll take a quick look at Microsoft. If anybody has anything else they want to add, I'll stay on for another 5 or 10 minutes if it's really dire and you really want me to look at something for you. Oh, wow. Geez. Microsoft is another one, guys. These charts are so bearish still. It's holding on to this level right here, which is 250. Got to hold on to 250. To me, it looks like Microsoft is kind of similar to Apple here, where a little bit of bullish divergence. Recently hit a low, just like Apple, okay? Recently hit a low, just like Apple. Looks like it wants to turn up for the short term. I don't think these are long-term moves that it's making, though. So even though it has a 1 and a 2 count to the downside, MACD looks like it's heading in the right direction. The TTM is starting to head in the right direction. So overall, I could see this kind of heading sideways to up over the next few trading days. To me, the scary one is Google right now. So, all right, guys, I guess I'm going to sign off here. If nobody else has any call outs or any questions, hopefully you guys enjoyed that, and hopefully I brought some value. And Celsius was a nice, interesting call out, guys. Put that one on my radar. And there will be a devoted video coming out for HIMS. So if anybody's invested in HIMS, let me know. So yeah, man, if you ever want to come, so I'm technically in yeah, no, absolutely, Tony. Glad to have you here, man. Appreciate the kind words. Yeah, I live on the Tampa side. I really live in the St. Petersburg, Clearwater area, but Tampa is kind of where we relate ourselves. But yeah, Anthony, shoot me a message and we'll plan something out here in the next few weeks or whatever if you're on this side of the coast. Guys, as always, really appreciate your time. Thank you guys so much for spending it with me, and we will see you next time, investors. Peace.